and welcome back. So after the last break, we are here at the last session, last panel discussion of the day, focusing on sustainability in banking, and you could say the best for the end. As we already touched on quite a few topics, we have one very important topic still left, and that is what exactly sustainability means for central banks, which look after monetary policy, financial stability, but how sustainability principles are integrated and how climate risks can be integrated into what central banks do. And we have a very interesting panel, and we hopefully will try to answer some of these questions. So to the stage, I will kindly ask the moderator of this session on central banks. That is Reiner Martin, Head of Research of the National Bank of Slovakia. Then we also have Mark Campanale, founder of Carbon Tracker. Please, Mark. We have Eva Zamrazilová, Deputy Governor of the Czech National Bank, and Norbert Holzinger, Head of Department Sustainable Finance, Magyar National Bank. So, please, the floor is yours, and to you, Reiner.
Okay, thank you very much. So I'm very much aware of the fact that we are standing between you and the subsequent drinks, tour to somewhere, and your free evening. So I think we have a very interesting topic, but we'll make sure that we stick within the allocated time. So let me just to set the scene a little bit. I've been a central banker for about 20 years. And when I started, central banking was a pretty unidimensional business. So you had the mandate to ensure price stability. Now that was, of course, not always easy, but it was quite clear what the mandate is and what you need to do. And then came the sequence of the global financial crisis, the euro area sovereign debt crisis, and that complicated things already quite a bit, because suddenly there were issues like you needed to preserve banks' liquidity for longer than you would normally do, or you had to think about asset purchase programs, and quantitative easing was developed, TLTROs and the like. So it was an outburst of creativity on the central bank side, I would say. But that came also at a cost, because in some countries at least, it led to questions about the mandate of the central bank and whether it's stretched too much and going into areas that really central banks shouldn't be covering. And now, of course, we have the involvement in the climate change agenda, and that is also something where the merits, I think, are clear. But at the same time, questions come up whether this goes maybe a little bit too far. And I would like to open with two quotes from a conference that recently took place at the Riksbank, the Swedish National Bank. And there were some very, very different views on the topic we had. So let me start with a quote by Mr. Powell, the chairman of the Board of Governors of the US Federal Reserve. He is saying, "We should stick to our knitting and not wander off to pursue perceived social benefits that are not tightly linked to our statutory goals and authorities. We are not and will not be a climate policymaker." And then at the same conference, there was also a presentation by ECB board member Isabel Schnabel, and she had a completely different view. So she said that the ECB should step up its efforts to make its monetary policy more climate-friendly, possibly by harnessing its multi-trillion euro stock of bonds. She said, and I quote, "It would be misleading to use tighter financial conditions as a scapegoat for further delays in the green transition." So you have a pretty large spectrum between Powell on one hand and Ms. Schnabel on the other hand. And I think it will be very interesting to see what our panelists think about it and where you stand on this Powell-Schnabel spectrum. So without further ado, let me give the floor to the first panelist, and I would kindly ask you to also briefly introduce yourself in line with what we had in the previous panels. So Eva, if I could start with you. And the question to you is, have central banks been pushed too far in terms of what they might be expected to do with regard to climate change? And should central bank mandates be changed to include action on decarbonisation or climate change related issues?
Well, I think that the first and core mandate of every central bank should be price stability. Well, we all know, as you have kindly mentioned, that during the financial crisis, the world has discovered the problem that the inflation targeting itself doesn't safeguard financial stability automatically. Therefore, in the previous decade, many of central banks have got a new type of mandate, that's financial stability mandate. And new kind of policy has been created, that's macroprudential policy, completing the macroprudential policy. And why I'm speaking about that, I think that, for instance, in our country, the climate risks have been already incorporated in the financial stability, network, the system, because the tests, all the stress tests, etc., we have just been incorporating the risks of climate transition and the materialization of climate risks, like of course, some problems of natural character. We try to work with those risks as just to incorporate them into the traditional set of risks. And the bank themselves feel very strongly that there is a reputational risk and a negative sentiment risks for them if they don't comply with all those new needs of the green transition, of course. And of course, we all know that the decarbonisation is a must. So the banks themselves incorporate these risks as well into their operational assessment. So I would answer your question that I wouldn't say that primarily or directly the mandates of central banks should be given also the climate change risk, etc. But I think that this indirect peer pressure is very useful for all of us to work with in the new arrangement. And then maybe later in this discussion I may add some more issues and more details into this. But I think that my statement is my position is quite clear.
Well, thank you very much. So on your side, you see that there could be some flexibility on the mandate. At the same time, you're saying that the banks have already very much incorporated what they need to do. It's also interesting you refer to macroprudential policy, because that's another policy area where very often there's been discussions about, should that be done by the central bank. So we may possibly refer to this later on. Okay, let me now move to Mark, and if you could give us your thoughts on what threats to macroeconomic and financial stability does the climate change pose? I mean, we covered some of this already, but maybe we can recap that a little bit. And how, in your view, should the central banks react to this?
Yeah, thank you, Fo. I'm probably the only person on the panel who's not involved work as a central banker. I worked in fund management for 20 years. I'm an economist, and Carbon Tracker, we don't track carbon, we actually analyze the energy transition, and we model future coal, oil and gas production. So I just want to pick up on the first point about price stability and inflation. So if we look in the last year, the main driver of inflation, obviously, certainly in the West, certainly in Europe, has been the appalling war in Ukraine. And that's impacted us in two ways. Firstly, energy prices, and that's fed through to industry. And we've had massive interventions by the state to control prices. And the second is food prices. So in the United Kingdom, where inflation is running at 10%, food inflation is running at 20%. And part of that is the cost of heating greenhouses. But the other of it is hey, who knew? We make fertilizers from gas. We don't need to make fertilizers from fossil gas. We can make fertilizers from hydrogen, from green hydrogen. But the big inflation in food has been the rising costs, particularly of fertilizer and the availability of fertilizer, and Ukraine being an important exporter of fertilizers and seeds and so on and so forth. Now, my remarks about price stability is the problem, and it's just reflected in my first points, is that we've got a commodity-based energy system. So we're dependent on two parts of the energy system. One is the stock, actually how do you create your energy, and the other is your flow. So gas, coal, and oil being a commodity, that's your flow, and it's inherently inflationary. So all the cheap energy has been found, and all the expensive stuff is what we move on to next, unless you're in the Middle East. But all the players outside of the Middle East, listed companies, private companies, are playing in the expensive field. So you have to go up into the Arctic, you have to go to ultra-deep water. The costs of extraction are exorbitant. And once you've got your oil, if you're in Canada, you have to boil it up, put it in a pipeline, send it to a refinery. If it's a gas, you have to compress it, put it in a ship, send it across the sea, decompress it, transport it to a power station, burn it in a power station, and then if you're clever enough to remove the CO2, you then have to pay for the CO2. Inherently inflationary. Now, renewables is inherently deflationary. It's a technology. It's based on electrons, as I made in my earlier remarks. It's a technology, and we know from technology that's on learning curves, it just gets cheaper and cheaper and cheaper, to the point where the marginal cost of energy in the future is going to be zero. And the reason for that is once you've paid off the cost of your system, all the fuel, sunlight, the wind is free. So what we're studying is actually how the total percentage of the household spend for energy for the average consumer should fall, and it should fall significantly in the next two decades. And that deflationary impact should be good for the household as deflationary. And in turn, these cheap energy systems will actually lower the cost of production for the manufacturing base. So that's good for the broader economy. So my first point is that the energy transition is inherently deflationary, and instead of the volatility that we're seeing in commodity prices driven by things like the war, actually the volatility will be removed, and we should look forward to a period of long-term price stability. Now, my second point is about should central banks really worry about climate risk? And is it straying outside of the remit? Now, let's go back to my old job as in fund management. You've got to do two things well as a fund manager. First, you've got to know what assets are worth today, and you've got to know what the same assets are going to be worth in the future, and what are the factors going to impact the valuation of those assets. So in the clean energy transition, we've built a fossil fuel-based energy system and manufacturing system, and because of that, we have built a fossil fuel-based banking system that sits on top of it. The whole of the banking system and capital market, not all of it, but a significant proportion, is orientated around supporting an energy system which is disappearing and a transportation system which is disappearing. So what are the assets of the fossil fuel system? If any of you are kind enough to download the size and decline and fall of the fossil fuel system off Carbon Tracker's website, you can see we run the numbers. About a half of global non-bank bonds are linked to the fossil fuel system: shipping, aviation, cement, steel, the whole of the construction industry, power and transportation, and about a quarter of global equity markets are linked to the fossil fuel system. And we have about 20 to 30 trillion dollars of fixed assets, and we're going to have to lose half, if not more, of that over the next decade or so if we're to achieve net zero. So, and if we're committed to 1.5, we're going to have to see that. So one of the first things we're going to see is auditors and accountants stress testing the value of assets held by companies on their balance sheet. Now, why is this a problem for the banks? is you've got loans secured against the value of the assets in the case of a company. So if your assets are worth 500 million, you might be able to borrow $1 billion. If your assets are worth 250 million, the equity ratio changes, and all of a sudden, the amount you can borrow contracts significantly. And so you've got a contraction. You've got the banks calling in more collateral against those loans. So you've got the challenge over the value of the collateral. The second is the pricing of assets. What everyone fails to notice is that in the case of public markets, for both bonds and equity, prices are set at the margin. So if you look at the value of oil and gas companies in the last year, they're up by, what, 70%? 70%, probably. Exxon, Shell, Chevron, they're up 70%. What percentage of the total shareholders of Exxon had to buy or sell to drive the share price up by 70%? It wasn't 70%, it wasn't 20%. It was probably closer to about 5% of the shareholders in Chevron turned over their shares to drive the share price up by 70%. So it's another way of saying that you only need to get negative sentiment against the incumbents of the energy system to get marginal selling or buying that will drive prices around. So the corollary is the opposite. You only need a 5% change in the sentiment of markets towards a company for the share price to drop very quickly. Now, we saw this in the case of the listed coal companies in the United States. So when coal demand in the US fell by 2%, did the share prices of the coal companies fall by 2%, 20%, or 90%? I think you all know the answer. A 2% fall in demand for coal led to a 90% decline in the value of the assets. And of oil and gas companies, 100 million barrels of oil demand a day, a 5 million barrels of oil demand drop during COVID dropped asset prices by 50%. So the point being is that prices are set at the margin, and this is the vulnerability that the banking system and equity markets have, is the ability of markets to reprice and derate sectors very, very quickly. And that is the soft underbelly, I'm afraid, of the banking and financial system, is a derating of the incumbents of the fossil fuel system as we move to a new system, and central banks actually being asleep on the watch on this. You could call it transition risk. I do have other remarks on this, but I'll leave those for later.
Thank you very much, Marga. I think two things maybe just to add to this. So the first one, I found very interesting your statement that you would expect in the medium term a deflationary impact of transition, because I think that's in the public debate. This is not so sort of commonly the perception.
Yeah, I mean, not tomorrow, but the expectation is certainly within the next decade, possibly less than the decade.
And of course, bringing a bit of a regional angle to it, I mean, the banking systems here in Central Eastern Europe, they are kind of typically quite plain vanilla banking systems. So most of the assets are mortgages or SME loans, this sort of thing. So these sort of huge swings in large corporates is not something you would see so much here. But that's just from a sort of regional perspective.
And also you've got the benefit of all the new investment in the last 20 years has been for modern machinery and equipment designed for an efficient European market. And I wouldn't expect for you to see huge write-downs of assets, unlike other parts of the global economy where you've got systems in place for a long period of time. I mean, what you have to worry about is gas storage and pipelines built with a 30-year life that only have a 10-year life. That's probably where we have to worry a little bit.
All right, thanks very much. Let me then turn to Norbert. So Norbert from the Hungarian National Bank. The initial question for you is, how can we better integrate this climate-related analysis of long-termism in central banking? And are the current prudential policies effective to curb the climate-related risks or alleviate the downturns?
Thanks. At first, I would like to react to the thoughts about central bank's mandate, because I'm in a special situation since the Central Bank of Hungary, or in short MNB, received the sustainability mandate as one of the first central banks in Europe in 2021. But I think that this green mandate is not a precondition for green central bank activities. It helps and it provides more opportunities, but it's not a precondition for for example, in 2019, MNB launched its first green strategy, the so-called green program, which is a comprehensive program, and in which we took a lot of measures. For instance, issued recommendation for banks to improve their preparedness and green awareness. We started a preferential green capital program to incentivize green lending, or we performed some stress tests covering not only banking sector, but in this year, insurance sector as well. I think that based on financial stability mandate, central banks can do a lot. Yeah, and regarding your question about long-termism, yeah, this is the famous thought of Mark Carney about tragedy of horizon. That he said that in monetary policy, the typical horizon is 2 years long. In financial stability, a bit longer, about a decade. In my opinion, it can be even longer, because there are some financial products whose duration is longer than 10 years. For instance, mortgage loans or life insurance products or pension products, their duration can reach 30 or almost 40 years. So this long-termism sentiment is in the financial product development, and also in prudential policies as well. So I think the basis exists. We can't change a lot in our mindset, but we have to use our possibilities.
Could I just ask you, because you said that the MNB was one of the first central banks to get a green mandate. Was this something that was really completely a new mandate, or was it sort of a specification of the financial stability mandate, or how was that done at the time?
It's a new mandate. The first mandate is price stability, and the legal act said that without jeopardizing the first mandate, MNB take care of financial stability, support the government economic policy, and also sustainable policy.
Okay. I mean, in a way, that's similar then to what the ECB is doing. No, it doesn't. Yeah. It didn't actually have this mandate explicitly, but of course it has the secondary mandate to support the general economic policies, and that's what it's used then to deal with these issues.
Yeah, and maybe one more thought regarding long-termism, because I think that central banking in the spotlight, everybody, or central bank activities are watched by everybody, not only by financial institutions, but also the public. So if a central bank says that climate change is important, we have to deal with its impact, its long-term impact, it will have the consequences. So this is so the example is very important, I think.
I mean, on that, Eva, how is the discussion in the Czech Republic regarding this issue? Was there a discussion to change the mandate, or because some central banks are much more skeptical, and actually also when you look within the euro system, so some of the central banks are much more reluctant to get involved in these issues than others. So what is the situation here?
The situation here is, I would say it's quite similar to Hungarian situation as regards that in our mandate we do also have to support the general economic policy of the government. If the first and core mandate of price stability is not jeopardized or is not under question. So I think that for the time being there is no need, or there is no need and nor will to open again the CNB law, because it should have been opened. And because we have a novel of the central bank law, it's I think 2 years ago. So that we really will be supporting the government stance if our price stability mandate is not in problem. And I have to say, at the moment, we are under really very strong pressure of the media, of the general public, of the entrepreneurs, as for the inflation. And of course, that's terrible. That's really very terrible. It's not like in the Eurozone everywhere. Maybe in some countries there is, I think it's much worse than, for instance, in Poland or in Hungary, because we have the highest interest rates in history, and still there are some academicians, economists that say we have to go, we still have to go up more than 7%. So this is our, of course, there is a tie to the energy prices, etc. So we also have to know that and have the analysis that if we are to support or somehow to have some political responsibilities for the green transition, we really have to know and have the analysis that this will be not pro-inflationary, because I agree fully with you that in the long run it probably will be deflationary, because there is technology change and productivity change and everything. But people in the Czech Republic are not very long-term forward-looking, but they are a little bit myopic, and they are interested how to pay the energies tomorrow and what will next winter be. So we are really very strongly pressed by the public opinion now to fulfill our basic mandate. So if we, in some media space or etc., we will start a discussion about green transition, I think that the timing is not perfect today, unless we should be really able to prove that this will help them with inflation in the mid-term horizon, at least in the mid-term horizon. And so this is difficult.
Mark, I think, did you want to react to this?
I mean, it's an important question. I mean, but it's an area for innovation in the banks. I mean, today in the United Kingdom, we have a mortgage bank called the Nationwide, and they've launched a zero-interest product today to retrofit homes. It's a green mortgage. So you can essentially acquire the equipment to decarbonize your home for heating, for energy at a zero interest rate. And I think we need to see more of those. The other product that we saw last year was a home builder and an energy company offering homes free energy for life. So what they were doing, they're putting in battery storage, they're putting in solar and an electricity EV charging point, and all of the energy that the house generated went into the grid for free. And when the grid needed access to the stored energy through the battery system, they got that back for free. But in return, the household got all of their energy free for life. Who would say no to that?
Absolutely.
I think we need more of this kind of thinking. We need more imaginative thinking, and central banks should be talking to the retail banks to actually say, look, let's think through how quickly we can offer these products to the consumer, because the consumer is also the voter in most cases. But how can we get this quickly to the consumer, but also to industry as well?
Let me get to, so we have two quite interesting questions here on Slido. The first one is to you, Eva. Do you also feel that the financial risks associated with biodiversity loss are priced into the Czech banking sector?
Well, I think that the risk management of the Czech banking sector now is very prudent, appropriate, and of course I think that our banks, as most of them, they are not purely Czech, they are the daughters of big mothers from France, Austria, yes. Belgium, etc., and so they are obliged to act in the whole company, multinational company. So I think that it very much depends on the statement of their on the policy in the mother country, and you know. I think that France, Austria, Belgium, and Italy are quite responsible countries in this sense, but we have to look at the behavior of the banks also from this point of view. But as for the financial stability, the risk assessment of the banks, I think, is quite appropriate.
Okay, I mean that's certainly for the Slovak banking sector. I would cautiously say no to that, because I don't think this is the biodiversity. I mean, this is really like a new frontier, I would say. Climate change, yes. But let me get also to the second question, because that's of course a bit provocative, but it's also quite a pertinent one. So to what extent does the expansion of the mandate or the activities that central banks are doing act as a smokescreen for do-nothing politicians? So is this something that came across your mind, or you're worried about? I think it's more for Eva and Norbert. But of course, if you like.
Well, I may add to our previous question that in our financial stability report in autumn, we have incorporated a special scenario about the risk of climate change, not only for banks, but also for, let's say, insurance companies, and that were very harsh scenarios, very hard conditions. Well, 2 years of no water, or otherwise floods, etc. So we try to also to be very careful about that, and well, I think it depends. So it depends on the country itself. I think that you have yourself, you have started with 2 different kinds of opinion from both sides, two sides of the world. So I
no, but is it
say that it's not the same everywhere.
Is it something you would see as a risk in Hungary?
Yeah, it's a hard question. I think that everybody shall do what they can do in order to reach results. I would like to react for the first question, because biodiversity loss, because I think that this topic has become more and more popular for the last months, but we don't have enough information about this topic. And this is the reason why we started the project with OECD and the European Commission last year, because we would like to understand better the nature of biodiversity loss and the link between biodiversity loss and the financial sector. And as I know, this project is not the first, but among the first. So I think we have we need more information about this topic.
Okay. Any comments from your side on that?
Certainly in the United Kingdom, relationships between the financial markets and the bond markets with UK politicians is, as Dara said, very precarious. So we had a Prime Minister called Liz Truss. Does anyone remember her? And Kwasi Kwarteng, here and today, gone tomorrow. What happened was that when they announced their programme, the bond markets, the financial markets didn't believe it for a second and sold down the bond markets, driving up interest rates. And the government fell, in a matter of days. Huge embarrassment to the UK system. But what it revealed really is how binary, how close this relationship is. I don't know if you saw it, but two other chancellors of the Exchequer in the United Kingdom, George Osborne and Ed Balls, spoke in a parliamentary committee last week, actually arguing the case that climate should not be the responsibility of the Bank of England, and trying to make this case. I take the different view. I actually think that keeping this responsibility of financial stability and climate stability with the bank actually frees up politicians to find a little bit more wiggle room to develop other policies. Because when they actually look at the bank does something, the politicians can say, well, actually, it's not us. It's the central banks being very prudent. There is something which I do worry about with the central banks, and it's something that you probably picked up in the previous panel, is how the Financial Stability Board uses integrated assessment models. Ones where they suggest at 4 degrees of warming, asset values only fall by 3% or 4%. And we've actually seen this. I mean, the other area of the assets of the financial system are in pension funds, something that I look at very closely. And we have investment advisors in the United Kingdom that are saying that 4 degrees of warming, assets will only fall by 0.1%. I mean, the reality is nothing happens at 4 degrees of warming. And you've got these smart models also used by the NGFS. And something that the central bank should be doing is shaking off these very, very damaging and problematic, the Nordhaus damage limitation function, the DICE model, and coming up with something more aggressive where actually you have to say at 4 degrees or even at 3 degrees, what's the impact of GDP? And bearing in mind the world's on a 3 degrees pathway right now, what's actually the significant impact on GDP, and then in turn on asset values at that level of warming. And that's something I certainly believe that central banks should be doing free of political involvement.
I mean, that relates to the third question, which is, I think, also quite a good one. I mean, would you agree that regions' central banks should design climate scenarios? I guess yes, probably that would be my guess at least, because I think generally there is a lot of agreement on the fact that central banks need to get on top of the assessment at least. No, I think this is not really something that has been put into question very much. What is the impact on financial stability and on monetary policy? But let me get to another question, because beyond the analysis, there's of course the idea or the discussion about whether central banks should be more proactive. So should they, for example, tailor their asset, well, previously the purchases, now the sales of the assets in a way that fosters climate change? That deals with that. So is that something that is relevant in your central banks? Is it something that you take into account?
Well, the Czech Central Bank has never been purchasing any kind of assets. We didn't have those kind of non-conventional monetary policy. We have had our FX floor for a couple of years, so we are in a different position, and there is of course some possibility incorporated in the new central bank law adopted, I think, in 2020 or 2021. However, this mandate for purchasing asset is tied just to monetary policy, as a monetary policy tool in case of necessity of further losing monetary policy. I think we are far from the situation that we will be in need to lose monetary policy in some foreseeable future. The opposite is true.
Hungary is a different case, no? You did purchase assets, no?
Yes, MNB had asset purchases programs, but now we don't have. We must find solutions which in line with monetary tightening in this time, and I think that this is the time for methodology developments and policy settings, so which are neutral for monetary policy. For instance, last year the supervisory strategy of MNB was updated, and environmental risk or environmental sustainability became more prominent than before, and I think that this is a clear message for market participants and also for the public that we are committed to this topic. Or, for instance, another example that we continue our capacity building projects, which are utmost important because without capacity, the green transition won't be successful. So we hold university courses and other courses as well. Or another example, which is not fully capacity building, but partially, that in April we started our new application. This is the so-called Green Product Finder, which is a web application. It contains a lot of data regarding green investment products, so which are in line with Article 8 and 9 of SFDR. Now it covers mutual funds, unit-linked asset funds, and pension funds, and people can compare the features of different products and find relevant information about these products. So we hope that this application will support the increase of green investment products.
Okay, let me maybe go to a related question to this. I mean, during the time of asset purchases, okay, not in the Czech Republic, but in Hungary and certainly in the euro area, because this was a big opportunity for central banks to, twist their purchases in a way that would also be beneficial for climate, which was used, I think, to some extent. Now, of course, that is not the issue now, so it's more about shedding the assets now, where you can also influence. But what is, of course, still there is the more prudential measures, right? So when it comes to microprudential or also macroprudential policies, what's your view on that? How do you see that? Is this something that should be taken into account when setting these standards? Maybe. Let's start from the back. Norbert, you start first, because I think you're the only central bank who has also done some green measure. No?
Yeah. We have taken some micro and macroprudential measures. For instance, in April, started the so-called green consumer-friendly loans project, which is a kind of macroprudential actions. Or another example that is from this year, we started to check the compliance with our green recommendation in on-site inspections. So I guess that this can be a good incentives for banks to to do more efforts on this this topic. Yeah, maybe this can these steps can be possible.
Okay. Eva?
In the Czech Republic, in our central bank, I think that these issues are strictly linked to discussions that we know are now led in European Commission, also European Parliament, and mostly we have contacts with the EBA, European Banking Authority, and of course this will be guideline for our regulation and our supervision, but I don't see most probably no gold plating in this respect. I think that we will comply to what is agreed. I think that we are quite close to some milestones that will be published, some new decisions, some new terms which will have to comply, and I think we will comply.
What's your view, taking into account also financial stability risks that may be associated with it?
I had my one chance to present to the Financial Stability Board with Mark Carney back in 2015. I always worry about whether I blew my chance at the time. But the point I was making was to do the way in which financial regulatory oversight of debt and equity markets is really important. In Carbon Tracker's first research we published in 2011, we looked at the remaining carbon budget to below 2 degrees. Today it's around 300 gigatons of CO2. We currently emit around 40 gigatons a year. If you just take the reserves of the listed companies, your Chevrons, your Glencores, Exxons, and so on, they own around 700 gigatons of CO2 in their reserves. In the last 10 years, if you can believe this, there's been 2,500 coal, oil, and gas IPOs globally. The biggest IPO in the UK last year happened in the middle of the COP, was an oil and gas company, the 5th biggest in Europe. They've raised probably around $1 trillion in equity, probably a multiple of that in debt. And today, 10 years on, there's around 1,060 gigatons of CO2 in the reserves of publicly traded fossil fuel companies. It's another way of saying that with all this regulatory oversight and interest in climate, the capital markets have become more carbon intense, not less. So something's not working. And it's to do with the central banks and the Financial Stability Board's relationship with IOSCO and the World Federation of Exchanges. And I think if there is such a thing as a culprit, I'm not sure that there is, but if there is, we've got to get IOSCO on board with the Financial Stability Board and the central banks, looking at what kind of capital markets do we want. Making them more fossil fuel intensive is idiocy. The year before last, there was an IPO of a coal company that happened in the middle of the COP, 6 times oversubscribed. The capital markets are going very short-term signals. We're not giving them the long-term signals. I have some thoughts about how we deal with that, but probably not for today. But this is where we need to take the central bank conversation, is what does authentic, rigorous oversight of debt and equity markets actually look like, and how do we create a financial system for the next century? And I'm not sure we're anywhere close to it, I'm afraid.
I mean, again, I think here in the region, it's more about banking regulation for relatively standardized assets, right? So
that's true, and that's true. I mean, the equity market problem is not a Central European problem. It's a North American, it's a UK,
Absolutely.
It's some of the, it's a German and French, and obviously an Asia problem as well. But so I can't say you've got off lightly. It's just that your exposure to the problem isn't so dramatic as other financial centres. But it does mean that probably how you develop your equity markets actually is a chance to get it right. And something that you should all look at if you've not done is something called the Sustainable Stock Exchanges Initiative, which is an initiative of UNESCO, of all people. Is that right? I think that it is. Why it's there, I don't know, but it's inside the UN system. The sustainable stock exchanges about actually how do we get, and many, many local exchanges are part of this, how do we get markets aligned with net zero?
Okay, so the last question is also interesting. So if I think the CB, a central bank, is doing too little, too much, the wrong things to fix climate change, what can I, as a citizen, do to effect change? And I think that's an interesting one because it goes down to the heart of central banking in a way, right? I mean, the central banks have been entrusted with a certain mandate, and they're accountable, of course, but they are largely taken out of the sort of, parliamentary control in a way. So, and for monetary policy, that's clear. No? It's based on research and evidence, and this is fine. But as I said at the beginning, I think for other tasks, this is a bit of an issue. So let me. I think we're coming towards the end of this, and I'd like to just take that last question again and ask you in turn. So what is your take on it for your central banks and for you, Mark, about central banks in general? Are they doing too little, too much? Do they doing the right thing? Of course, you would assume they do the right thing. And how do you see yourself on this sort of Schnabel and Powell scale that I mentioned at the beginning? Are you more on the side of Mr. Schnabel or more on the side of Mr. Powell in that debate? Eva, do you want to start?
Yes, sure. I feel much closer to Jerome Powell, of course.
To Jerome Powell.
Yeah. I think that if the European Central Bank had been taking more seriously the inflationary prices, the inflationary pressures, it wouldn't have been necessary for today to be in such an inflationary mess. So I think that the main mandate should be given priority, and if we have this first and main homework finished, I think we can go farther to be helpful for the economy, the society, etc. For instance, we are very active in financial literacy, by the way, for many years.
And yes, too.
Yeah, we are. But still, I think that the most urgent and pressing issue today is the inflation.
But just to understand you correctly, so is your argument then to say that maybe so the attention was not fully on the main mandate? Is that what you are saying on the ECB side?
I think that the statements of the new leadership were very much oriented to the green transition, etc., and were saying about that they will closely watch the inflationary pressures, and I think that the tightening of monetary policy came too late. Okay, that's my.
Yeah. Albert.
Primary mandate is primary, so I think that monetary cycle and inflation situation defines the framework. So this is the primary mandate of MMB as well.
If you want to deal with the inflationary problem, accelerate the energy transition. And by dealing with the energy transition, accelerating it, you'll solve the climate crisis. So I'm in favor of intervention. I just want to make a remark about, I don't know how many central bank historians there are in the room. Now, if you know about the history of the Bank of England, there was a competition for two banks. Mm-hmm. The central bank, the Bank of England was going to be a mercantile bank, but there was a competitor. And it was a land bank, because the main form of assets in the 17th century was agricultural assets, land. And if we tie back to this question about nature-based solutions and biodiversity, there is an argument that we should actually create a stock of natural capital, do baselines, which is kind of what you're doing in Hungary, a stock take of your natural capital. And actually, we lend against the value of natural capital. I want to go back 250, 300 years and have the re-argument again about whether UK should have had a land bank, a bank based against natural capital, or whether we should have had a mercantile bank. Well, we know history showed that the Bank of England, as we know it today, was a mercantile bank to fund and support manufacture and trade. Actually, if we look at the climate crisis and the loss of biodiversity and so on, I think there is an argument to go back to a different kind of central bank. A little bit philosophical, but we're allowed to do this. We're at a conference. But I'll leave that for him to think about.
So let me just, I mean, I'm not going to try and wrap this all up, but I would say, first of all, this was a really interesting discussion. And I think, if I understood you correctly, I think we all agree on the fact that certainly the central banks need to fully understand what is the impact of climate change on both on prices, but also, of course, on financial stability. And I think there is still a lot of work to do. I think what I found also interesting is that none of you was worried about more active intervention, like you're doing, for example, for this green macroprudential policy. That this would be covered under the mandate. So maybe we don't need a new mandate, but you think that these general clauses on supporting general economic policies is probably enough to do that. But I don't think we have any convergence on the Schnabel and Powell scale. So on spectrum, I think there are still some differences here. And I think this discussion is likely to continue for quite some time. So thank you very much, and yeah, I would like to ask you to join me in congratulating the panelists and thanking them.
And Reiner, thank you so much for the great moderation as well, and thank you, Mark, Eva, and Norbert as well for joining the discussion. And so this discussion wraps up this day, second day of the summit, focused on sustainability in banking. So I do hope that you agree with me and that we actually managed to cover all the different aspects of banking sector and sustainability and what sustainability means in practice for bankers, not only commercial banks, retail banks, but also central banks. Now, I thank the speakers from today, the audience, all of you, also for asking really good questions, people online. And maybe just one last message. We'll be actually going for some drinks now to the Augustin Hotel, which is also in Malá Strana part of Prague. So we are all welcome. So we'll be actually walking from here in a couple of minutes. So you can join us and we can all have some more drinks and a little bit of networking. So you're all invited. And that's everything for us for the second day. And tomorrow we have a day focused on energy. So again, we need more energy even for that day. And we are expecting some really interesting discussions as well. So thank you so much.